So let's look at the fiscal element of Ghana's petroleum fiscal regime. Now, before we look at the fiscal element, what is Ghana's fiscal regime, or what fiscal regime does Ghana operate? Ghana operates a royalty tax system with what we call state participation. Other school of thought deem Ghana's fiscal regime as hybrid, but it is not hybrid. It is royalty tax system with state participation. Royalty tax system because royalties are levied on the production of the contractors and taxes are levied on their income. And state participation because GMPC on behalf of the government of Ghana is a joint venture partner in all petroleum operations conducted in the country and constitutes a joint venture partner. Are you getting it? So it contributes in the form of what we call carried interest and additional participating interest. So that is the fiscal regime of Ghana. Now, what are the fiscal elements that exist in Ghana's petroleum fiscal regime? Fiscal elements refer to the various benefits that accrue to government in the participation of the oil and gas fiscal regime. They refer to mechanisms government use to collect revenue in the participation of the upstream petroleum sector. So every fiscal element has to have some characteristics or qualities or features. And these include one, neutrality. The fiscal element should not have a negative impact on the investor. And two, we have equity. The fiscal element should also aim to treat all investors or interest holders equitably and fairly. Now, there should be administrative ease. Fiscal elements are said to achieve administrative ease if they ensure that the collection of revenue is very simple for tax administration. And they should also be progressive. Progressivity means, or progressiveness means that the fiscal instrument's sensitivity to industry profits. Are you getting it? To ensure that government revenue increase when profits also increase, or profit of contractors also increase. So it follows the progressive nature of profits and taxes. Okay, so what are the various fiscal elements in Ghana's fiscal regime? So first we have royalty, which is a payment for the right to take oil or gas from the land or sea. It is mostly levied as a percentage of the gross value of oil and gas won, irrespective of profitability. So royalty rate ranges between 5 to 12% of gross production. Now, in terms of royalties, when it comes to minerals, it is 5% of the gross income or gross production. So when you get any question relating to mineral royalties, you just take 5% of the gross income as the mineral royalties or gross production or gross value of minerals won, which is the production. So we first have what we call the initial interest or carried interest. Now, as I said earlier, GMPC on behalf of the state is a joint venture partner in all petroleum operations. And because of that, GMPC holds a percentage interest in all petroleum operations. This entitles the state to a share of the oil produced without making financial contribution towards exploration and development costs. Government will only have to contribute towards production costs, being its proportionate representation. So the minimum rate is 10%. So it's like it is an automatic interest where government does not contribute towards exploration and development. You need that because when it comes to questions on distribution and crude oil, when you are computing capital allowance and you have to share the exploration and development costs, you have to note whether it's initial or additional interest because government does not contribute towards exploration and development. So it only contributes towards production. That is what we call the initial interest, and therefore entitled to any share of revenue that the parties may share. Now, the next one is additional participating interest, or what we call working or paying interest. Since you had an automatic interest, if you want an additional interest, what do? So the government or GMPC can avail itself for additional interest, which will require the state to pay the proportionate share of only the development and production costs because government never contributes towards exploration. So no exploration and appraisal cost is paid by the state. It is an option incorporated into the petroleum agreement to enhance the state's benefits, which are exercisable by the state within 90 days, subject to petroleum agreement after declaration of commercial discovery by the venture or the investor company, or what we call the contractor. So with this one, the government contributes towards development and production to take an additional interest in the oil and gas operations. Government in no way contributes towards exploration, so be careful when it comes to distribution of crude oil questions or computation of chargeable income. When you are computing capital allowance, you must know how to share when additional interest should come in. Okay, so therefore, because government pays a portion of the production and development, when there's any share of profit, government also has a hand in it. Okay, the next one is, remember, it's royalty tax system, so there might be tax elements as well. So the first tax is petroleum income tax, which is a tax payable on the income derived from oil and gas production. It includes corporate tax, which is at 35%, withholding tax of subcontractors at 15%, and employment income tax at the graduated rates. Okay. Now, the next type is a windfall tax, which we call additional oil entitlement. So, this entitles the state to a share in the excess profits accruing to the contractors. It is also called supernormal profit tax. This is levied in case of a windfall profit where the venture's actual internal rate of return exceeds a target rate of return used to evaluate the profitability of the venture during negotiation. So it's like there's a specific return that is supposed to be achieved. When your return exceeds that particular target, then it triggers an additional profit tax which you have to pay. And this can be in barrels of oil or it can be levied in cash. Okay, the next is what we call surface rentals. And this one, when fiscal elements are examined, apart from royalties where you can have calculations, surface rentals can also bring calculations. So you must always pay heed to the various rates of surface rentals. So surface rentals, contractors are obliged to pay surface rentals for blocks assigned to them for petroleum operations. So the basis of payment are as follows. So we have the phase of operation, which is you are given 7 years. So for the initial exploration period, you pay $30 per square kilometers. And after that period, we give you an additional extension, which is the first extension period, where you pay $50 per square kilometer. Then from there, we give you a second extension period, which you pay $75 per square kilometer they give you. So in exam, you just, if they give you some square kilometers and they give you that they have been at it for this number of years, you know, the first, you are given 3 years, then 2 years, then 2 years. So initial exploration period, 3 years, first extension period, 2 years, and second extension period for another 2 years. So it's like if they give you the 3 years and you find oil, you can't find oil, they take a portion of the land from you and give you a first extension period for another 2 years. If you can't find, they take another portion, which they give you the second extension period. Now, when you find, then you get the development and production where you pay 100 per square kilometer. So, in simple terms, what we mean is that even after the initial exploration phase and you find some commercial discovery, you don't need any first extension, second extension, straightforward, you move to development. So, it depends on your ability to get crude oil in commercial discovery. So, that's how it works. So, in exam, open your eyes. If they give you some square kilometers or whatever, just be this one. Nobody will give you these rates in exam. You have to remember them yourself. Okay, remember them and multiply them by the square kilometers that have been given. Okay, so that is surface rental. And during our practice session, we'll look at some questions. Okay, so the next is what we call technological allowance. So this technological allowance or technology allowance is a one-time payment by the contractor to assist GMPC to procure plants, equipment, and machinery that are required for petroleum operations. So you have to make some payments to GMPC so that they can buy plant, equipment, and machinery that we will use for the petroleum operations. We also have training allowance, which are some annual payments that the contractor will make to support GNPC in training human resources for the petroleum operations. So it is mostly using human resource capacity building. Then we have dividends, which are payable by GNPC to the government in terms of equity interest. Then we have capital gains tax, another tax, which is applied when the international oil company sells its petroleum assets and realizes a profit. The tax is charged on that particular profit, which we call the tax on gains of on realization of assets. Then we have investment income. So the Petroleum Revenue Act provides for the investment of Ghana petroleum funds, which is stabilization and heritage funding in financial instruments. Interest accruing from such investment constitutes petroleum revenue. Now we have signature bonus and production bonus. So what you need to know is that what is bonus? Bonus is a fixed fee that is paid by the oil and gas companies to the government at different stages of the project. So it is a fiscal element of some production sharing contracts, but in Ghana we still pay bonus. So we have two types of bonus which are signature bonus and production bonus. So what is signature bonus? Signature bonus is a lump sum fee that is paid for securing a license or exploration right. So it is paid for you to secure a license or a petroleum exploration right. It is up it is paid upon signing the petroleum contract. It is, however, not a feature of fiscal regime of all states. Some states may charge a minor fee for handling minor applications. Then what is a production bonus? This is a lump sum fee paid when production reach an agreed threshold. So if your production reaches a specific level, then they can levy this production bonus. So production bonus may be required at when you make commercial discovery or at the start of your production. So upon a certain level of production, such as based on a daily production or cumulative production. So that is what we call production bonus. Now, because bonus is an expense, and people may be thinking that bonus is an allowable deduction. No. For tax purposes, under Act 896, bonus is not an allowable deduction, but is treated as a capital expenditure, and capital allowance is granted at 20% on straight line basis. So that is how we deal with bonus. It's a capital allowance expenditure. Okay, so now we look at the format for distributing crude oil. Okay, now when you want to distribute crude oil, you must first get the gross production in barrels, take out royalty, then whatever you have is the net production, which you share for the respective investors, which are the respective joint venture partners, which include government and the contractors. But note, sometimes, because I told you government does not carry out any exploration activity, sometimes government can carry out exploration and he takes what we call sole risk. So we call it sole risk operation in the petroleum agreement, where government carries out exploration. So government has to be given a portion of the oil to cover his cost case because he's a sole risk operator. Now, if you see sole risk in the exam, they can tell you what it is levied upon. Most of the time, they will tell you it is levied on production, just like the royalty. So after you take your gross production, you less your sole risk, your sole risk operation or your sole risk received by government, which is also on production, just like the royalty. So you less your sole risk, you less the royalty at 10% or 5% or whatever it may be per the question. Don't assume. Use what is given in the question. Then you get your net production. Then you share between government and the contractors, which government will take its initial interest, his additional participating interest, then the partners will also take. All are levied, or all these percentages are levied on the net production after the royalty, or where there's sole risk, the royalty and the sole risk.